Open any social media app, and you'll find a teenager in a luxury car claiming tapping buttons is the secret to wealth. They present day trading as a reliable daily income stream. If someone actually possessed the unique skill to consistently beat the market averages, they would not need to sell you a $300 membership to prove it. Generating consistent excess returns is so incredibly difficult that the few people who can actually do it raise billions of dollars from institutional investors. They run exclusive hedge funds and take home astronomical performance fees. The wealth these influencers display usually comes from membership fees and course sales, rather than the trades they demonstrate on screen. To see what happens when regular people actually try this, we can look at the industry's own internal benchmark, the 90-90-90 rule. It states that 90% of new retail day traders lose 90% of their starting capital within their first 90 days. Leveraging a trade, borrowing money to multiply the position size, accelerates this countdown to zero. A single bad price swing can wipe out an entire account in an afternoon. The brokerage apps do not mind. Their systems capture a fraction of a cent on every transaction, extracting profit from the sheer volume of trades, regardless of whether their users win or lose. Day trading operates as a mathematically predictable wealth transfer system, moving capital out of retail accounts and into the hands of market makers. This chart tracks the survival rate of 19,000 retail futures traders over 300 days, revealing a catastrophic flatline. 97% lost money. Of the few with a positive return, only 1.1% earned over minimum wage. The single best trader made $310 daily amidst extreme volatility. On a larger scale, researchers analyzed a complete dataset of all transactions on the Taiwanese stock exchange, spanning over a decade. They found that individual active traders consistently underperformed the overall market index by 6.5% annually. Collectively, retail traders lost nearly 2% of Taiwan's entire GDP to trading losses and fees. On a global scale, the active retail trader acts primarily as a mechanism that hemorrhages wealth into the financial system. Why do smart people continue to lose money, even with access to real-time market data and professional charting software? Michael Mauboussin describes this as the paradox of skill, a phenomenon that occurs in highly competitive environments as everyone's capabilities increase. Ted Williams hit over .400 in 1941, and no one has matched it since. Today's baseball players are better trained and better fed, but because everyone's baseline skill has risen, finding a relative advantage over the competition is nearly impossible. In modern finance, institutional supercomputers and high-frequency algorithms set the baseline, executing complex trades in fractions of a millisecond. When competitive skill levels reach total saturation, any remaining variance in individual outcomes is determined strictly by luck, not strategy. Retail traders buying attention-grabbing stocks aren't executing a hidden edge. They are blindly providing liquidity to vastly superior institutional machines. Even when retail traders get lucky, they fight their own biology. The human brain is evolutionarily hardwired to treat financial volatility like a physical threat. This leads to the disposition effect, where retail traders sell winning positions too early just to secure a psychological dopamine hit. In the face of a loss, traders often double down on losing positions in a panicked attempt to avoid the emotional pain of a realized failure. Because these flaws are biological, there is zero empirical evidence of retail traders learning or improving their habits over time. Active trading places the human brain in an environment where its default survival instincts guarantee financial ruin. Millionaires accumulate capital through the steady application of mathematical certainty. This chart shows the historical compounding growth of the S&P 500. High net worth individuals favor broad market index funds for their statistical certainty. Over 90% of active fund managers failed to beat this index. Buying the benchmark captures average market returns without the stress. Millionaires automate this process through dollar-cost averaging, investing a fixed portion of their income at regular intervals to remove human emotion from the equation. Wealthy individuals seek the mathematical guarantee of long-term compounding rather than excitement in the stock market. High net worth individuals also employ a secondary multiplier, legally shielding investment growth from government taxation. Vehicles like Roth IRAs and corporate 401k matches create an environment of tax-free compounding and provide access to mathematically free capital. The single most significant driver of this long-term compounding strategy is the focused allocation of active daily energy. Instead of staring at candlestick charts, wealthy individuals focus 95% of their effort on scaling their primary business to generate high surplus cash flow. True financial success requires making your active labor the wealth generator, and the stock market your strictly passive, emotionless compounding engine. Stop trying to beat the market and just own it.